All right, how's it going, friends and family? My name is Amos, and I'm having a pretty bad weekend, right? Every single one of my favorite sports teams that I root for, they're losing. They've lost, defeated. And to further shove a cantaloupe right up my booty hole, we're almost at the end of 2025. I guess a more balanced take would be it was a pretty good year for me. I've been out of my depression for 2 years now. I became a first-time father in October. And that newborn, the baby daughter, dude, she's been crying nonstop day and night. If you can't tell by my eyes, but terrible sleep quality. And my Seattle Seahawks, they're playoff contenders, even though the NFC West is kind of up in the air right now. However, on the investing side of the house, this is where that cantaloupe is going right up to my stomach. It wasn't exactly a Bob Ross painting. In this video, I'll be going over the stocks that I sold for a loss this year, but more importantly, the lessons I have learned from these losers. So if that sounds good with you, I feel like there's value add for everyone. Let's go ahead and get into it. To kick things off, let's go ahead and talk about YieldMax, right? I feel like YieldMax was all the rage, had so much hype back in April, May, and June. And I remember everybody, they were just selling straight out of SCHD, jumping ship, because with YieldMax, if you jump on over to their dividend profile, 143% dividend yield, right? I think the prospectus, the documents say they try to aim and strive for a dividend yield of at least like 80%. So for the dividend yield to be 143%, that means the share price got demolished, decimated. And as you can see, year to date, negative 55%, that does seem to be the case, right? I think they started out the year at about $9 a share, and since then, it's just been NAV erosion. So this is stock number one, I guess ETF, that I sold for a loss, Alti. The second one that belongs in this same family of YieldMax ETFs was Misty. I also sold them for a loss. And as I talk about YieldMax, we could also bring along Roundhill. Although I've never owned any Roundhill ETFs, I would argue they're pretty much in the exact same ballgame and territory of NAV erosion and their ETFs panning out the same fate as YieldMax. And I'll be honest with you, I bought into the hype, but just for fun. Deep down inside, I knew that YieldMax is a red flag, so I didn't put that much money into it, right? I only put a couple $100 into Misty and a couple $100 into Alti just to see what would happen. And after enough time, I saw enough, I felt enough, and I realized, dude, this is not smart, right? So I jumped ship at the end of October, sold at a loss, I think. Overall, with both Alti and Misty put together, total return, I think I was down by $12 overall. And that's with the dividends taken into account. But the thing is, had I just held on to Misty or Alti, I think the damage would have been a lot worse. So I guess you could say that I'm a YieldMax survivor, and I can't be the only one out here. I'm sure a lot of us, just for fun, we saw, right, the dividend profiles of like a 286% dividend yield. We're like, dude, let's just give it a try. Just some fun money, some gambling money, couple $100 here and there. I can't be the only one. And I think we all kind of learned that if it's too good to be true, it's usually a scam, right? That's the conclusion that I have reached when it comes to YieldMax and Roundhill. I'm not a fan of their investment style. It's not sustainable. And as you can see, the NAV erosion is it's way too much. And the NAV erosion is really important to take into consideration because when I say NAV erosion, I'm talking about the inherent worth of the share price dropping from about $29 down to $7 because that also affects the dividends that are paid out, right? So if we do, I don't know, when the stock price was really high, they were able to afford $4.42 every month. But as the stock price continues to drop, look at how the dividends paid out gets dropped as well. Eventually, their dividends per week might even be as little as like 5 cents, 2 cents, 1 cent. And I'm thinking, I don't know if this is going to happen, but I think they're going to do a reverse stock split because at $7 a share and with Alti almost in that penny stock territory, they're probably going to do like a 5-for-1 reverse split just to keep them alive. And I think the only winners here probably the fund managers of YieldMax and the fund managers of Roundhill, because they do charge a fee for their services of running this Ponzi scheme, as some people would like to say. I don't think it's a Ponzi scheme. I just think it's a poorly executed strategy, a 1.3% expense ratio. And you might laugh, but when you take the assets under management into consideration of $1.4 billion, that's how much money is pumped into their ETFs, a 1.3% fee out of that, they're making a pretty good profit. But in a weird way, I also think it was a good learning moment for everybody that's in the dividend investing community, because now we know for sure if something pays a dividend yield above like a 20, 30, 40%, it's usually not going to be sustainable. And that is the example and truth for the YieldMax ETFs. I've since sold out of the YieldMax ones and I shifted the money on over to the NEOS ETFs. I think, yes, I'm sacrificing the potential yield. The profile is not as juicy at 13.6%, but the difference, friends and family, is you tell me, are you seeing NAV erosion or is the share price being preserved? And in the case of QQQI, it's even going up by a little bit, right? This one only takes into account the share price appreciation, but if you bake in the 13.6% dividend yield, you'll be in the green by a significant amount. My personal favorite right now is the BTCI, because my investing thesis for Misty at the time was they're an account treasury for Bitcoin because they hold a good chunk of the Bitcoin that's revolving around the world. But with BTCI, you're investing into Bitcoin, like directly investing into Bitcoin, but also you're getting the covered call options income from it. So of course it's going to underperform Bitcoin by a bit, but you're still going to get a juicy dividend that's going to be sustainable, right? And the reason why I like BTCI right now is because when you think about Bitcoin itself, they're going on a sell-off. So BTCI, they're going to be following the exact pattern of Bitcoin's valuation. I'm sorry, I live in Japan. That's why the valuation is kind of wonky. If I scroll on down to United States dollar, you can see year to date, they fell off a cliff about negative 16.8%. Pretty much what's happening with BTCI as well. I'm thinking once Bitcoin makes their inevitable rebound, because I feel like a lot of people always doubt Bitcoin, but then given enough time, they always make a rally and they reach a new high, right? I could be wrong, but that's just what I'm thinking. Then BTCI is going to follow suit and they're also going to recover. So I've been putting more money into BTCI. With Misty, I don't trust the YieldMax fund managers. I've always been skeptical of them, and now I know for sure I'm never putting my money anywhere near YieldMax or Roundhill. NEOS, I think they have a more sustainable strategy that does seem to make sense, and I can align with better, and I agree with them more. Another NEOS ETF that I think is pretty high quality is the S&P 500 Income ETF. You could see year to date, you're not experiencing NAV erosion. Quite the contrary, actually, their share price appreciation, right? It started out in January at about $50, 76 cents a share. Now it's $52.67, and they're able to sustain their very high dividend. I think for me, what good is it to see a 100 or 200% dividend yield if the valuation of your asset is just dropping like a rock? So I consider me losing money in YieldMax as tuition for learning the hard way, right? I just wanted to see what would happen, and the conclusion I reached is not worth it. And it's definitely one of those lessons that I'm going to carry with me forever. Because usually when I make a mistake in life, personal relationships or in the workplace, or in this case in the stock market, I usually reflect and I always think back to XYZ and I try not to repeat history. So the next one that I sold for a loss is Booz Allen Hamilton. This is a company that I covered on the channel a few times, actually multiple times. And they're basically in the business of doing consulting for the government. So all of the various three-letter agencies, and instead of a traditional format of what management consultants usually do from like Deloitte or Boston Consulting Group, Booz Allen Hamilton, they usually do staff augmentation. So they put butts in seats in a three-letter agency and literally do the jobs of that government agency, except they're not under the payroll of the government, but they'll just send billable hours to the government, if that makes sense. And I genuinely think it's a pretty great business. It's just awful timing. I think I got really unlucky because I started to buy into them, I think, in September. And then in October, we had the longest government shutdown ever, right? And by the time Congress finally stopped arguing, I think the damage was already done. So if you take a look at what happened as the government shut down, this stock just got obliterated. And I think a lot of stocks got hammered as well because it was contingent upon the government reopening. And with Booz Allen, since the government was shut down, that's a lot of revenue that they're going to be missing, right? So I think it makes sense as to why the markets punish them. And taking a step back, I just feel stupid because I got it wrong, right? I didn't anticipate the Congress negotiations taking that long, right? I thought it would be quick and fast and efficient, with the current administration, but man, I didn't think it was going to be the longest government shutdown in U.S. history. So definitely feel stupid about this one. But if you take a look at this company, I still think it's really high quality. I mean, that's exactly what you want to see in a dividend compounder with cheese. The revenue is consistently and reliably growing year after year. Obviously, for the trailing 12 months, it's slightly declining, and that's because they're losing contracts because the current admin, they're not really gung-ho about government spending, right? They're trying to pull back on everything, including Medicare, Medicaid, subsidies, WIC, food stamps, and in this case, government consulting as well. So for me, I was like, okay, I'm going to buy the dip while they're going through a temporary setback, because once the next administration transitions in about 3 years, I think it's going to be back to how things were, right? So I was going to buy into the fear, buy into the dip, but I think the government shutdown just ruined everything. And I think the profitability of this company is just getting better and better. They're becoming more efficient and running more lean. And that's because, unfortunately, I think almost every single quarter in 2025, they've just been doing layoffs. So they're doing more with less, which I'm not exactly a fan of, but it is optimizing their bottom line. And their free cash flow situation is pretty darn good as well, right? $800 million of cash on hand. And think about it, it's a consulting firm. They're not manufacturing equipment. They don't have factories building out phones. There's not, if any, CapEx built into this company. And their balance sheet is pretty good, $800 million of cash on the books to that of their total debt of $4.1 billion. And I know it sounds scary and significant, but if we look at the debt to EBITDA ratio, then it sits at a 3. The golden ratio for me is a 3. So they're sitting right at the standard, which means it would take them roughly 3 years of their core operating profits remaining the same to pay off all of the loans. Which for me, I think that makes more sense because I don't think a company would ever get to the point or desperation of using all the cash on the books to pay off their loans. And their dividend profile is magnificent as well, right? A payout ratio, super sustainable, meaning from their profits, how much of it is going to be utilized to afford this, the $2.20 in dividends per share, only 33%, which means they have 60+% of their profits to reinvest back into the business, to grow, to do R&D, to hire more consultants, to do whatever. So the lower this number, the better it is. The dividend growth rate being a 7.8%, for me, the golden standard is to be around that inflation number. That way, your purchasing power of your passive income stays up to date and current. Because the value of your $1 today, it's going to be worth a lot less in 10 years from now, right? So you want to see the payout be keeping up with inflation, and dare I even say, to do better than that. The historical rate of inflation fluctuates from like 2 to 3.5%. So 7.8% to be double that, I like. And even during the pandemic, they did not cut their dividend, right? So very high quality company. And I think their future with helping to transition to government with their outdated IT platforms, because I'm a veteran and I can tell you right now, their websites and their infrastructure blows. It sucks. So it's up to companies like Booz Allen to help them transition into more up-to-date and efficient websites and platforms. And I think that's going to print cash for this company going forward. And as of right now, the leadership team, they're prioritizing cybersecurity, which, as we all know, is really urgent. So I think their future business model will be safe, but I know there's some people that say consultants will be irrelevant 5 to 10 years from now because of AI, and everyone's just going to rely on AI to do this and that. But I think that's going to take time. I think that's going to take decades to make consulting obsolete. So until then, I think Booz Allen Hamilton, Deloitte, Bain, and McKinsey, I think they'll be okay, and they'll continue to print cash. And another thing to note is, if you take a look at their top line, we're talking about $11.7 billion in the past 12 months, right? Their backlog of contracts right now is $40 billion. So once they're good on their part, that's $40 billion of revenue that's going to be pouring in. And that's why I really like companies that do business with the military, especially with the government. I know right now it's kind of a gray area and it's not exactly a lucrative industry because there's funding cuts and slashes with the budgets happening. However, I think that's a temporary thing. I don't think that's going to be the norm. I think this administration is really aggressive with slashing the funds, but I think in 3 years, things will be back to normal. I think once we realize that we did too much of one end of the pendulum, it's going to go back the other one. And I think we're going to overspend to make up for how much we've been slashing. Because we're going to realize, like, when you cut that much money from the government's budget, there's going to be a lot of problems. So having said that, I do like this one. And I plan on buying back in once the wash sale roll period is over for me. And that's going to be in mid-December. So for me, I'm literally just waiting a couple more weeks and I'll buy back in. So again, it's a high conviction pick for me. I just wanted a lower cost basis. I think I started to buy into them when they were about $91 a share. And then I think my average cost basis was like $87. But during the government shutdown, once I saw them drop down to like $79, I was like, okay, I think I'm just going to sell out of it right now at a loss. That way I can buy back in when they're like $83, $82 in a matter of 30, 60 days. And before I move on to the next stock that I sold for a loss, if you take a look at their share price history, they're essentially at a 5-year low, which is pretty crazy to see. But it does seem like they're in a free fall, right? And I mean, they're having a small little rebound, but to see their valuation, they're trading multiple being a 12.7 when I think their historical PE, let me pull it up right here. Booz Allen Hamilton, PE ratio. Their forward trading multiple based on next year's EPS, it's a 15. Case in point, if you take a look at the past 15 years, on average, their PE ratio is a 25. And if you only look at the past 10 years, then it's a 24. Past 3 years, it's a 25. So for them to be at a 12.7, I'm like, okay, the markets are basically pricing that this company's going to go belly up or that it's a dumpster fire of a business. However, I don't think it's a dumpster fire. I see opportunity and I see value. Who knows? Maybe next year, if I do make this video again, I could say, okay, I did buy back into it. They dropped even further. I shouldn't have bet against the current administration. Like, I knew that they were going to be slashing funding and budgets for anything related to the government. I should have seen it coming. But I think for me, Booz Allen Hamilton, high quality compounder. But moving on to the next one, I sold out of this one at a loss and I do not plan on buying back in, and that's going to be FMC. To give you the 101, they're in the business of selling agricultural pesticide, insecticide, herbicide. Basically, it's a pharmaceutical company for farmers and for produce and for plants, flowers, and everything else that grows in a garden or on a farm. Pretty simple investing thesis, right? They don't even have a current PE ratio because their earnings per share is a negative $4.38 of profits. So they're losing money in order to operate the business. However, predicated upon next year's EPS, then their EPS is a 5. A 5. So taking $14 and dividing it by next year's EPS, you get a PE ratio of a 5. I'm going to be completely honest with you. I'm not really feeling this one, but I thought they were a good opportunity because at the time when I decided to jump into them, I think their PE was like a 4 or 5 or a 6. So I was like, dude, I think they're really undervalued. But friends and family, there's a lot more to a company than just their PE ratio. In hindsight, it was absolutely a terrible idea, right? My left nipple was screaming at me to avoid this one, but I let this get into my head. I was like, well, the valuation seems pretty low. And when I was considering their share price history, I was like, this is a company that used to be like $130, $140 a share back in 2022. And being at, what was it, like $40 a share when I bought into them, I was like, I think it's a good opportunity now. And it just goes to show, just because a company used to be $100 in the past, doesn't mean they're ever going to get back up there, right? But in the grand scheme of things, if you consider their total stock market history of just their share price appreciation, it is 4,900%. But my goodness, going from about 130, 140 a share down to $14, that's crazy, right? And I think it's because fundamentally, FMC and the sales of pesticides and herbicides, it's not something that agricultural companies buy every single week, every single quarter. Sometimes they buy a lot more upfront and they don't buy for the rest of the year. Meaning it's very cyclical, especially the prices of their sprays, implants, medicines. The reason why my left nipple was screaming at me to avoid this one is when you take a look at their revenue situation, when you buy into a dividend compounder with cheese, you're buying into something that is reliable, predictable. What do I mean by that? Let's take a step backwards. That means every single year, because of their product or service, because of their economic moat, because they're so high quality, because their operations are so important to society or to their customer base, it is always going to go up. But in the case of a cyclical company, no matter how high quality they are, they're going to have highs and lows depending on the market cycle. And I really wish I would have reminded myself of that lesson. But I was just blindsided by their dividend profile and their PE ratio. Looking at their revenue, my left nipple was like, dude, it's declining. What makes you think they're going to make a rebound? And a part of me was like optimistic. I was like, well, they probably could, right? It's a cyclical company. Now it might be time for their comeback. Are they making that comeback? No, they're not. So their revenue, inconsistent. Their earnings per share, it was pretty rock solid. Leading up to 2024, $10.55 of profits per share. I think that's pretty high quality, right? But since then, it's just been dropping like a rock. And now they're unprofitable as a business. To be unprofitable means they're burning cash in order to keep their business alive. Not a good look. Something else that's bad, if we jump on over to their balance sheet, right now, cash and cash equivalents is $500 million or $497 million. If you compare that to their total debt of $4.6 billion, I don't think that's too bad in terms of the cash to debt ratio. But if we take a look at it from the debt to EBITDA, their debt to EBITDA is 8.2. That is alarmingly high. It would take them 8 years and 4 months of their core operating profits remaining the same, the EBITDA, to pay off the loans on the books. 8 years. Friends and family, so there's red flag after red flag after red flag when it comes to this company, and I got it wrong. I messed up. I thought the rebound was going to happen. It didn't happen. And as a matter of fact, they just kept free falling. So all that to say, it's the first and the last time that I ever invest into a cyclical chemical company. Like you might think because they dropped from 130 a share down to 55 or 53 a share, they're going to bounce back up to 100. That $100 a share might not ever come. This is a perfect example of when people say past performance should never be indicative of future gains. Just because a company used to be 135, it does not mean they'll ever get back up to that share price again. So actually, I'm not even that bitter. I think I was really upset because I lost money on them. But once again, I think of it as me paying tuition to the school of hard knocks. Sometimes you just got to learn the hard way. And for me, I learned it, right? I only had 5 shares, but it still hurts, like the principle of losing money. So it just taught me to never, ever put my money into low conviction businesses ever again, especially if I know that the financials and fundamentals don't make sense. I think if they don't have any signs of a promising future, and there's no catalyst in their favor, and I'm just watching their stock price drop, and that's why I should buy into it because of the rebound, I need to stay away. And I think FMC, they have taught me that lesson where I will try my best to never do that again. And I think with FMC, on the topic of learning stuff, right? I think I'm learning more about myself as a man now that I'm a dad. I know I look really young, I'm 35. Sometimes people meet me and they think I'm a college student or that I'm like 21. Bro, I joined the military like over 16 years ago. I went to grad school. I worked in corporate America. I would argue like an early adult. I've kind of lived life, right? And one thing that I've noticed about myself, like when I was younger, dude, I was an adrenaline junkie. I was always the kind of guy that wanted to be in the front when it comes to roller coaster rides. Whenever there was a flight mission, I would volunteer. Loved going in the Chinooks and whatnot. But now that I'm getting older, something about me, it might be embarrassing to say, but my risk tolerance is not as high as I thought, right? I think in the past, I was like, yeah, I guess I could put some money here, and if it pans out, that's good for me, and if it doesn't, whatever. And I'm learning, like, I don't think I like the whole gambling mentality. But alongside with that, something else that I'm learning about myself is that I like to drink milk almost as much as my 5-week-old daughter. She's almost 6 weeks old. And I finally understand why some dads wake up super early to have some alone time. I feel like I get a lot of my stock research and a lot of my work done early in the morning, because once the day really begins, it becomes so chaotic and there's so many things happening left and right that you don't really have time to do that deep thinking. However, circling back to the whole idea of the stock market and how it's relevant to this channel, I'm also learning that as an investor, I don't like the roller coaster rides of cyclical stocks, because you really don't know what's going to happen next. Like, you bought into it at $75 a share and it dropped on down to 57. You're like, okay, I think now's the time to buy into it. And if you fast forward a little bit, it dropped further into 35. But had you just held on, they did make their little rebound as the market cycle swings back into their favor, and it even went to as high as like 138 a share. But since then, it dropped like a rock. And that's why when it comes to like buy and hold forever, I truly think there's only a few category of stocks and industries, less than 100 in the stock market. Out of all the publicly traded stocks, I think there's less than 100 buy and hold forever. Everybody else, it's a buy and evaluate once in a while, like every quarter, at the minimum once a year, to see if the investing thesis still makes sense. So with like FMC and other cyclical stocks, I think I don't like, because you have to really pay attention to see what's happening with their market cycle, because their stock price could go down by 90%, or it could go up by 200, 300%. And for me, that's when I would want to sell out of it. I guess the point that I'm trying to make is I definitely prefer the slow and steady, the boring, the predictable dividend compounders, rather than the cyclical stocks that may or may not rebound, right? So even though I lost some money with FMC, I think the wisdom that I can take away from that decision is going to affect how I invest in my 40s, 50s, and beyond. So I think even though I lost money, like money went out the window, I think it was worth it. No more cyclicals for me, which is a perfect way for us to segue to the next stock, which also operates in the cyclical space. I think this year is when I just made that all-in decision to just jump ship with all the cyclical businesses that were in my portfolio, because it just doesn't align with my strategy anymore, right? With UPS, this is a company that I have been dollar cost averaging into since like 2021, right? Because I think the investing thesis at the time, e-commerce was on the rise because of the pandemic. Less and less people are going physically into the stores, and that was a reality, right? And then their stock price even reached the high of about $200+ a share, and I was like, dude, this stock is awesome. However, once COVID-19 started to become more like a flu rather than an illness that will literally make you croak, stores and jurisdictions, they started to open back up. That means less people were ordering online and more people wanted to go to the actual shopping malls or to the retail stores to do their shopping. And consequently, their shipping volume, it dropped. And it dropped like a rock throughout the quarters and over the years. And being stupid, I kept dollar cost averaging. I would pick up one share here, one share there, and I kept doing that up until the beginning of this year. And I decided to just sell out of it, because I tuned in to an earnings call, and I think that was the last straw. I lost all faith in the CEO that's driving the bus. And doing some research into her, she comes from a finance background. I get it, right? Usually the CFO is next in line to become the CEO. But in my opinion, I feel like the chief product officer or the COO should be the CEO, because they understand the operations or the product itself. When you take a finance person and elevate them into the highest echelon and position, because historically that's what corporate America does, they don't really understand how to make the business thrive or what makes them unique or the industry itself. They might understand the profit margins and how to squeeze the value of their dollar out of their workers and whatnot, but I guess that's my unpopular opinion. I think people involved in the operations or the product itself should be elevated to leading the ship itself. With her, I'm not too thrilled, right? As a finance person, I think she lacks the understanding of the logistics and supply chain landscape, because I think prior to joining UPS, she was a part of Home Depot, part of their finance team. And under her leadership, dude, I'll be honest with you, I think UPS has just been failing. I think her vision is just, it's not working out. And it's to the point where she's allowing their major competitor, FedEx, to take market share. You would think the exact same thing is happening to FedEx, right? They're in the business of also shipping and delivering cargo across the world from A to B. If you take a look at their share price appreciation, it's the complete opposite, right? It's not dropping like a rock, such as UPS. I mean, they're also cyclical. There's ups and downs, but past 5 years, you would still come out ahead if you bake in the dividends that were paid out. With UPS, that is just not the case, right? Even if you bake in the dividends, being negative 43%, you won't come out ahead. You would be in the red, the total return. And I saw my position in the portfolio being deep in the red, and I had to ask that hard question. Do I still believe in this company and their future? I don't. I really don't. I don't like the CEO. I don't like how they're losing exclusive contracts for shipping out and delivering products for the major players. And their biggest revenue driver, their name is Amazon. That customer, it's slowly and surely they're doing their own deliveries. They're not relying on UPS anymore. So, I mean, they still are to do the last mile delivery for very rural areas that doesn't make sense, or places where they just don't have drivers signing up to be a 1099 employee to deliver packages. So Amazon still uses UPS for those instances, but for the most part, Amazon, they're cutting ties, and it's being reflected in their very cyclical revenue. I would argue up until 2022, it was just compounding, it was predictable, it was reliable, but since then, it's dropping. It's not consistent. I mean, we're not going to be looking at their free cash flow because UPS is a very CapEx heavy business, and I don't think it's fair to assess them by their free cash flow, because this is a company that is going to be constantly renovating and refreshing their fleet, their trucks, their vans, their warehouses, the conveyor belts. So it's not fair. So I'm only going to be looking at their income statement. I mean, it's just dropping like a rock. Their margins, their profits, their revenue. Not too happy. If we take a look at their debt to EBITDA ratio, what are we working with? It's a 2. So that's not too bad. Because I'm going to tell you right now, I guarantee you the debt on the books is going to be horrific. $6.8 billion of cash on hand. What does that mean, cash on hand? It's anything that's invested into, or I guess cash put into highly liquid stuff, like a savings account, money market funds, CDs, anything where you could just transfer it into your hands as liquid money in like an hour or 2, or sometimes like 24 hours. Total debt is $29 billion. And some people might be like, oh, that's so much debt, and dismiss UPS. But based on the debt to EBITDA ratio of being a 2, not bad at all. Dividend though, that is juicy, right? I'm going to give them credit where credit is due, but the payout ratio being 101%. So the dividends paid out is $6.56, right? Keep that number in mind. If we jump on over to their EPS, it's $6.47, which means that's their bottom line per share. And of that, more is paid out to the dividends than they are making in profits per share, which means they're dipping into their balance sheet or taking on loans in order to finance the dividend. And once a company moves in that direction, I know that dividend's going to get cut. I could be wrong, but with UPS, I jumped ship at around this point right here before they dropped even further and further, because for me, I just don't believe them anymore. Now, on the other side of the argument of them losing the Amazon contracts, it's not all doom and gloom, because the Amazon packages that they were doing for them, very low margin. So for UPS losing that, I don't think it's the worst thing in the world, but it still does eat away at their revenue potential. But I think it's one of those things where UPS, they really opened my eyes into evaluating and looking at Amazon in a fair manner. Because for the longest time, I was an Amazon hater. If you're a friend of this channel, then you know. I used to say, dude, I don't like Amazon. I don't want to invest into them. But the more I think about Amazon and all of their different business categories, like Amazon advertising, their e-commerce platform, their delivery modality, and in the cloud, AWS, I mean, just everything that they're involved in, dude, it just makes me bullish. So for me, instead of UPS, I started to invest into Amazon because I see them becoming the biggest guy in the room that's just all roided up, 300 pounds, has like a 500-pound bench press. I see them being that guy in the supply chain space who I think could potentially even acquire and buy out UPS, if for anything, for their fleet, their network, and their warehouses and whatnot. So if I'm bullish on e-commerce rising and the modality of getting those packages delivered to customers that don't want to go into the store, I'd rather invest into Amazon. I think with UPS, you would be playing with the third, fourth, or even fifth best player in that space. Why not just go with the best in class, right? So if you're still invested into this one, I wish you guys luck. For me, I do not have faith in them. I don't see a catalyst going in their way. I don't know how they're going to turn things around with their current CEO. I don't want to be too negative, but and for the next stocks that I sold for a loss this year, well, technically I didn't sell them yet, but I am in the red. It's the grocery store CPG stocks. So General Mills, Flowers Foods, and PepsiCo. I don't really have that much money invested into them, but it is worth noting that I am in the red with these companies. For the past 1 year, General Mills, we're talking about negative 28%. If we pull up Pepsi, I think I'm at break even with them. I think they're making that rebound now. Yeah, so with Pepsi, year to date, actually let's do 1 year, negative 8.5%. And then with Flowers Foods, they're also getting decimated. I think it makes sense, right? There's a rising trend of consumers buying store brand products, like at Walmart, Great Value, or at Costco, the Kirkland brand and whatnot. And of course, at Aldi and Lidl, the stuff that's imported from Germany and abroad. So I see why they're losing market share, because why pay $5 for the name brand box of cereal when you can get, I guess, quote unquote, the same thing for like $2.50. However, to that, I would say my investing thesis for the grocery store stocks, I think it still remains the same. Somebody has to make the store brand foods. And oftentimes, it's the name brand manufacturers. They're the ones who make it. It's just they put a different label for those products. But there are also private label food dedicated businesses like UNFI, PFGC, and then also Treehouse Foods. But I would argue the quality of their foods that are supposed to replicate the name brand stuff, it's never going to be the same. You pay less because you get a product that doesn't taste as good or has that signature flavor. So what I'm saying is with Flowers Foods, right? They make their own bread with the name brand label on it. But if they're making it for the store brand bread, they're still making money. Obviously, it's going to come with lower margins, but they're still making revenue from that bread. It's not like no one's buying their bread anymore, right? And it doesn't matter if the times are good or bad, people will still grocery shop and people will still eat. Unless everybody pumps their veins full of Ozempic and nobody eats anymore, and we just drink Go-Gurt and smoothies, and the way that we survive in this world changes dramatically. But as Americans, dude, we're fat. We love putting butter in our stuff. We love flavor. We love that umami texture profile, right? We're not just going to be defaulting and yielding to smoothies for the rest of our lives. I think grocery foods, they're in a pickle right now with a high inflationary environment, but food is essential today, and it'll still be relevant for humans 50 years from now. So I would argue grocery food stocks are buy and hold forever. Obviously, the ugly ones, maybe not so much, but the high quality ones like General Mills, PepsiCo, I'm sure. I am positive they will be okay. It doesn't mean they're going to be an outperformer, but what I'm saying is that they're still going to be relevant and printing cash 20, 30, 50 years from now. That's an important distinction to make. So buy and hold forever. And think about it like this, right? If the economy does go into a rough patch, which is why a lot of the restaurant stocks like Chipotle, Cava, Wendy's, they're all selling off, right? Less people will eat out and more people will choose to eat in. That means the grocery food stocks are resilient and will be in demand whether the times are good or bad. So I didn't sell out of them yet, but I am deep into the red with Flowers Foods. I'm pretty much break even with PepsiCo, and I'm slightly in the red with General Mills. But for me, I don't plan on selling out of them. Well, I might. Maybe I'll sell out of them and then buy back in at a lower cost basis. That's something I'll have to think about this weekend. And I mean, if we just break down Flowers Foods' dividend profile, 9% dividend yield, 107% payout ratio, on surface level, right? But that's because they're doing a lot of wonky accounting, manipulation, and engineering of their income statement because they're probably doing asset write-downs and whatnot. A more accurate depiction of their payout ratio would probably be the free cash flow per share, and that's going to be $1.53 of free cash flow per share. So if we take this number right here, let me pull up my little calculator, 0.99 cents of dividends per share, and you divide it by $1.53 of free cash flow per share, then the payout ratio is actually 64%. So very high sustainable dividend. Valuation is also pretty darn low. So as a value investor, I mean, I wear multiple hats. As a value investor, I still like the grocery food stocks. I could be wrong, and maybe one day they'll all disappear. But for me, I'll just continue to hang on to them or sell out of them and buy back in. I don't know. And so, yeah, basically, I'm the worst investor of all time. No, I'm just kidding. So this video, obviously, it highlighted the negatives, the losses, the stocks that I sold because I was deep into the red this year. But because of the winners in my portfolio, my total return, as you can see on your screen right now, is 2x that of the S&P 500. With the S&P 500, 14.6%, but because my winners outweigh the losers, my total return is 28.6%. So next time we'll be talking about the winners that I sold this year and the lessons that I learned. And by the way, if you are learning a thing or two from this channel and you appreciate the content, would you please consider joining the Patreon? It would mean a lot to me. And listen, it's cheaper than that OnlyFans subscription that you continue to pay for that you haven't told anyone about. So go ahead, cancel that OnlyFans subscription, and why don't you fund something that's more wholesome for once? Help a brother out. Even if you choose not to and you watch the video all the way through, I appreciate you. With that said, I love you guys. Stay safe. Good luck in the stock market. And let me know what are some lessons that you have learned in the stock market this year or maybe even 5 years ago. I shared with you all the lessons that I have learned. So, yeah, peace.